And welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman. We speak about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. And if you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think somebody might actually find this of interest, there's a little button there as well where you can share it. You can click on it and share it with whomever you want. So big news in Israel. Finally, the Bank of Israel has lowered interest rates, albeit a very modest 0.25% or 25 basis point reduction, bringing the rate to 4.25%. Bloomberg reports Israel lowered interest rates following a ceasefire in Gaza, though the central bank signaled a cautious approach toward future cuts in the face of criticism from the finance minister that it's not easing fast enough. Governor Amir Yaron struck a hawkish stance and said that he assumed there would be just 2 more quarter points through mid-September of 2026, which would then put rates at 3.75%. He cited geopolitical uncertainty, likely a reference to the shakiness of this Gaza ceasefire, and another with Hezbollah and Lebanon, as well as the potential for supply constraints to push up prices. Just last week, Morgan Stanley economists said they expected cuts of 25 basis points in every quarter of 2026, right, lowering the base rate to 3.25%. So according to Governor Yaron, Morgan Stanley is way too optimistic. We are still in a situation where the geopolitical and the economic uncertainties are relatively high. Yaron said in an interview after the rate decision, we're seeing a very active demand side, and we need to make sure it doesn't exceed the alleviation of supply constraints in a way that will trigger inflation. Those comments are unlikely to go well with far-right Finance Minister Bezalel Smotrich, who earlier criticized the easing of 25 basis points as being too little, too late for an economy strained by more than 2 years of war. Smotrich said, the economy is less challenged by inflation and more by growth, the minister stated in a video statement. Lower rates are needed to grant respite to the Israeli public after 2 difficult years. Yaron pushed back. Had we moved too early, we would have actually triggered inflation, and in the process could have damaged the anchoring of inflation expectations and markets trust. He said, any reverse course to such action would be painful. Even at current interest levels, we see an active economy and large demand. Sounds a lot like too late Powell in the States, right? Too late Yaron in Israel, not cutting sharp enough, not cutting rates quickly enough or steeply enough. Interesting. I'm going to take a different approach. It's all about growth, right? There are those who think it's all about the money, but it really is all about growth. Inflation is fine. It's under control in Israel. Growth would help alleviate a lot of some of the budget constraints that he's talking about, right? There are budget issues because of 2 years of war. And if we could actually grow the economy quicker, stronger, that would help stuff the coffers of the Treasury and help bring down or pay for the ongoing defense budgetary needs. The other issue is what's going on in the Israeli real estate market. Interesting. People aren't talking about this, but it's actually cooled in terms of sales volume and price growth deceleration driven by higher interest rates and the ongoing conflict. In late 2025, the Israeli housing market is very, very mixed, which is a big change for where it's been up until now, which was red hot. Okay, this was not being reported so much, but the number of transactions has fallen sharply, with some data indicating a 50% drop in deals compared to last year's peak. Investors' purchases in particular have plummeted due to high purchase tax, which is around 8%, and market uncertainty. While prices have seen monthly declines in some areas, the nationwide trend still reflects a modest price increase. For example, home prices were up 5.1% in the year leading up to July 2025, though growth has slowed from its peak, and that's continuing, right? That the 5 months from then, we see that things have slowed dramatically. Why? Well, first of all, interest rates are still very, very high. The other interesting fact is the accumulation of inventory. A record number of new unsold apartments are on the market, with some estimates suggesting nearly 2 years worth of supply in certain areas like Tel Aviv's central district. This oversupply has led to developers offering more flexible terms and may put downward pressure on future prices. That is a good thing, but what does that do? Okay, there's all these cause and effects. Yeah, there's a oversupply, which is good. I mean, oversupply will bring down prices. Maybe the reason for the oversupply is a little bit problematic, and it's also, and keep in mind, Israel has a very, very unique rental market, which is unique because there's no really established rental market. People don't build in Israel in order to rent out their apartments. They might buy an apartment and then rent it out, but it's not, and for the rentor, you have to be really lucky if you can find a long-term rental, long-term being defined as, anything more than a year plus an option for a second. People who are watching this who live like in America and other places, like, what? You can't like rent a place for 20 years? Not the same place. You can move 10 times during that 20-year process. But to get yourself a long-term rental you need a lot of luck. And what's this doing? This oversupply, right? This supply accumulation that we see right now, inventory accumulation. The decrease in new home investors means fewer rental units are coming onto the market, right? As we said, there are investors who buy and then rent it out, which combined with the high demand for rentals is doing what? Well, it's driving up prices even more than they're already driven up. Israeli rents have been surging over the years, and they're going to continue to surge because now, because of high interest rates, pretty much, nobody's moving on apartments, but they were being built. So you've got a built up inventory, huge inventory, nobody buying the apartments, and no new supply of rental units hitting the market, but an increased demand. So we know the laws of supply and demand. That is not good, which is going to then turn around and cause more inflationary pressure, right? So the same policy of very, very measured interest rate cuts are going to end up potentially causing more inflation. Okay, just cut. Okay, cut rates. Let's get rates down. Nobody's talking about a zero interest rate policy. But if you go, even according to what Morgan Stanley said, right, cut 0.25%, probably more. I would front load it, right? But if we can, in the next 12 months, get rates down by 1%, maybe 1.25%, you're going to see a booming Israeli economy. If you don't, I'm a little bit nervous that things aren't going to grow to potential. Okay, that's what we want, right? They'll grow. Israel's economy has been unbelievably resilient, as we've spoken about many times in the face of this war. But there's a potential growth that we're going to be short of because the constraints being placed on the economy by the Bank of Israel with continued policy of higher interest rates. You've been tuning into the Aaron Katzman Show. We speak about your life, money, and your investments. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. If you think somebody might find this of interest, maybe the head of the Bank of Israel, why don't you go ahead and share it with them as well? Thanks so much for tuning in, and we'll speak to you soon.